If you're Eastern or Central, you are in the afternoon. So welcome everybody to our live webinar today, Maximizing Schedule A Deductions. Definitely something that we can all get better at. And a follow-up to our Schedule C, Maximizing Schedule C Deductions webinar. Now, our panel today is Anthony and myself. Anthony, you are a solution architect and enroll agent for Wolters Kluwer. I'm a marketing manager, and I will be your host for today. So I'll manage your polling questions, manage the Q&A chat. So if there are any questions that I can answer, I'm happy to. But you are the star of the show, Anthony, with a lot of experience in tax and accounting industry. You are a practicing enroll agent that now works on our side of the business as a solution architect. And what that means is, you are really understanding what the technology solutions are there that can facilitate, helping problems and solving challenges for tax professionals. You have spent about 10 years as a practicing tax and accounting professional. Now, I believe, 3 or 4 years of that at Wolters Kluwer, and then the first 6 years or so just practicing, as an enroll agent. So a good mix there. And you have worked with many firms here in the Atlanta area, served individual clients, business clients, and a multitude of local nonprofit organizations. Your bachelor's degree in accounting, of course, plays a big role. And then your enroll agent title, which we appreciate because we can ask you those types of questions as you not only know the content, but you're actually supporting your customers with these types of tax returns. So with that, Anthony, do you want to go ahead and tell us what we are discussing today? Not sure. Oh, we do have one housekeeping slide here, and that is questions. Again, if you have any questions, I'll be managing the Q&A. So go ahead and enter your question at any time. I will be either reading it out loud for Anthony, or if I can, I'll go ahead and submit the answer right away.
Absolutely.
Yeah.
Well, thank you so much. Luis, for that introduction. You do a great job introducing me. I appreciate you, everyone. Today's discussion, we're going to walk through really some good strategies to use to maximize your client's tax refund utilizing the Schedule A itemized deductions. And I think the Schedule A has gotten a little bit less attention due to the Tax Cuts and Jobs Act, due to so many preparers are actually taking the standard deduction. And it's pretty common, if you got a client, married couple, and all their itemized deductions only come up to $18,000, $19,000, why not take a standard deduction, a $24,000 deduction, or even a head of household individuals take that $18,000 deduction. So there's so many tips behind it, and I want to make sure that we spend enough time with that client determining what's the best route, what's the best outcome for that client. So we're going to cover today, when should I force my itemized deductions to my state tax returns, right? That's something that comes up that a lot of preparers already sometimes don't take the time to think about that. You just kind of see, okay, you're getting your $24,000 deduction, but in some cases, taking the less deduction with the itemized deduction, if the client has less than the standard deduction, can be beneficial to that client. So we're going to go through that on today's presentation. And we actually had a trick question that came up on LinkedIn. Someone asked, well, what if there's no state return? Well, if there's no state return, there's nothing to force over to that state tax return question. So I appreciate that trick question that came in on LinkedIn earlier this week. So definitely, next item we're definitely going to cover is tax research to expand your client's legitimate tax deduction in Schedule A. We're definitely going to cover some of the research tools that we have available on our CCH Answer Connect or tax help tools that we have here at Wolters Kluwer to really help your client in maximizing those actual Schedule A deductions. And then also we got some good practical examples. So we're going to be doing the presentation inside of our TaxWise Online solution. We'll be doing it in our TaxWise Online solution. So definitely, if you got any questions, please don't hesitate. Post those questions in the chat box. And actually, I want us to go ahead and launch our first polling question. Before we do that, well, not that's the first polling question. One thing I want to make sure I address is we're going to go down that Schedule A from the top down towards the bottom, okay? And we're going to start off with medical deductions, right? So take into account your client's situation related to their health. That's one thing we're going to go ahead and launch. And it's funny, I've been doing taxes for about 10 years. I started out at Jackson Hewitt Tax Service doing returns there about 10 years ago. And, I just thought that I was just going to be doing, pushing papers and, taking deductions and W-2s and entering that information in and, doing a return. I didn't realize that I'm going to pretty much be involved in that client's lives. I didn't know that when I first got involved in taxes. So getting a good understanding of your client's, situation is really important, especially their health, and especially with this, this pandemic that's going on. When taking into consideration, what's their medical diagnosis, what's the medical procedures and prescribed medication. Now, normally when I used to do clients' tax returns, they would say, no, I don't really have much medical, but there's a way that you can go deeper and dive deeper with that client to see, is it worth it to maximize your schedule A itemized deduction. So Luis, if you could launch the first polling question, I'd love to see if we can launch that polling question.
Absolutely. And that first polling question is, can you deduct weight loss programs as a medical expense deduction? And Anthony, what we're trying to do with these polling questions, as this is not a CPE accredited session, really what we're trying to do is to get engagement, to see what everybody's comfort level is with the topic. And some of the questions will actually feed information back to you as a tax professional, just so you can see how you compare against some of the other attendees that we have joining today. So it's always interesting to poll the crowd, see what everybody's answer is. And with that, Anthony, we have about 65% answering yes, you can deduct weight loss programs as a medical expense deduction, and then 33% currently saying no, you cannot. Is that what we were expecting?
Oh, that's pretty good. That's definitely what we were expecting. And I'm going to walk you through some of those tools and how to determine if that's available for you. So first thing we're going to do is I'm going to pull over here on my screen before we go into TaxWise over here. I'm going to pull up on our screen. If anyone is familiar with our Answer Connect product, it's really connecting. It's a professional research tool connecting you to those answers that you need to make sure you prepare, to help you prepare an accurate tax return. So I'm going to come over here connected to you. I've got it pulled up over here, deductible medical expenses. And we actually have an explanation. These are deductions that can be taken, deductions that you can take on that client's return. And here are some of those things you can't take on the client's tax return, right? So for instance, I never forget, I had a client one time, and actually it was my dad's return, and he actually was telling me, yeah, I'm going to deduct the funeral expenses. Unfortunately, my grandmother had passed away, and he was saying, yeah, we're going to take a deduction for the funeral expenses. We're going to do that. And I had to kind of explain to him, no, we can't. And we kind of got a little bit of an argument there. But as you can see, those are non-deductible medical expenses. So we got a good explanation of that. Now, to address our polling question that we mentioned over here, it's right over here, weight loss programs for treatment of specific disease diagnosed by the doctor. So unfortunately, I mean, if your client has, if the client's been prescribed a particular, weight loss program due to due to what's going on with their health conditions, you want to get an understanding of that, because sometimes clients don't know this. You want to understand those lab fees that you pay. All these items add up. And one of the things I learned about, preparing taxes over my last 10 years, even if you have a belief or an idea that, nah, they probably don't have enough, and you just kind of skip over this section, taking the extra 5, 10, 15 minutes to go through these expenses, to go through these deductions, the client's going to appreciate it, and it's going to help in your retention. I never forget, I had a person that was sitting in my chair. I was doing their taxes at Jackson Hewitt, and I knew she didn't have these deductions. She said, well, she pretty much said, no, I don't have much of this, I don't have much of that. And then when we got done doing her taxes, even though she was getting a marvelous, a fabulous refund, she said, well, the other person who did my taxes last year, they asked me about my health. They asked me all these questions. They asked me everything. And, it just didn't seem like you did a thorough job. So you want to make sure, some clients, they're very sensitive when it comes to their money. You're the professional, you know what's going on. You still want to make sure you kind of ask these questions so the client can feel like they're getting a good amount of service from you. So let's take a look at this. Let's kind of go through this right over here. So we're looking directly at this, examples of the deductions on the left-hand side. So definitely the weight loss program. So for the 30 some odd percent of you that said no, absolutely, you do have the ability to take the weight loss deduction. So let's kind of bring this up on the screen here. So I'm going to shift gears for a second here, and I'm going to bring up our TaxWise Online solution up on the screen here, and let's kind of walk through this here. So as you can see, for those of you folks, if this is your first time using TaxWise Online or seeing TaxWise Online is a web-driven 1040 income tax preparation solution. It's a professional tax solution, right? This is not for the DIY folks trying to do their tax themselves. This is a professional income tax preparation solution. All right, so we're looking right over here at this at the Schedule A. Now, I just plugged in here about $50,000, but I put it at someone's W-2 at about $50,000, saying the average household income is anywhere from 50 to 60,000, right? So what's the rule when it comes to taking medical expenses? It has to exceed 7.5% of their adjusted gross income, right? It has to exceed that 7.5%. So since it has to exceed that 7.5% of their AGI, I'm going to come in over here and it's telling us, okay, so the medical expenses have to exceed $3,750 for this particular client. Now, this is the part where, 1 second here. This is the part where some customers get it confused. And I think this can also trigger an audit as well if you're not certain with the client. The client may say, yes, I have medical expenses, but the IRS is not asking you, okay, list out your medical expenses. The IRS is asking you, well, the expenses you actually paid out the pocket, the one that they physically left your account. Now, sometimes I get the question, what if I paid for it with a credit card? Absolutely. If you paid for the medical expenses with a credit card, that's fine. But it has to be where you paid with a credit card. It has to be where you, paid with cash. It has to be where it was actually paid, not, because you can have hundreds and hundreds of $1,000s in medical expenses, but they weren't actually paid yet. You get the deduction when the physical cash or when it's paid with a credit card. That's when you get the deduction. And if the situation is too, with the pandemic, and my heart goes out to you, and my condolences if you've lost a loved one, a family member from COVID-19. I definitely send some condolences out to you, or if you've got a family member, if you've been impacted by COVID-19, I wish the best and a speedy, safe recovery for you. So if you've got clients that have medical expenses incurred due to being in the hospital from COVID-19, this is definitely the year you want to make sure you ask about it because of the pandemic. So before we do this, before we go into this right here, before we go into the exact deductions, let's start at the top here. Let's talk about medical miles, right? What's the deduction for medical miles? Well, the software is giving away the answer, right? 20 cents per mile. So 20 cents per mile is that tax deduction, right? So you got to think about it. The doctor visits, right? Going to the doctor. And then now the thing is that, what you want to do is you want the client to go to the doctor, and then from the doctor, go pick up their prescriptions at the drugstore, right? The pharmacy, right? So how do we kind of calculate the medical expenses? One of the things you want to do, you want to sit down with your client, especially just kind of reconstruct, just get an understanding of them. And I hate to use the word reconstruct, get an understanding of what their medical commute is like. They're leaving their home. From their home, they're going to the doctor's office, they have to go to a specialist, things of that nature. Those are medical miles. So let's just say in this case, Aaron, I've got my example here. Let's go through for this taxpayer. So let me just scoot that over here for 1 second. For this taxpayer, I've got a couple miles in here. I've got my numbers buried in here. I'm just going to zoom in here for just 1 second. Just bear with me. All right, so I've got my medical miles here. Okay, so let's say that this taxpayer went through 430, had 430 miles, right? Now the spouse can have miles as well too. So you gotta think about it. Let's say you're married filing jointly, and unfortunately, maybe your spouse contracted COVID-19, and maybe your spouse was actually, maybe your spouse was actually in the hospital. So we're gonna go ahead and put some miles in there, about 870 miles we're putting in there. So altogether, we've got about 260 miles, but still it adds up because you're getting about 20 cents per mile. You're getting that deduction. Now let's go through these expenses that the client may have incurred. So let's say for medication, right? We're going to go ahead and put in here about $1,930 in medical expenses. Doctor visits, right? Let's go ahead and put this in here. Doctor visits. So we've got about, let's see, $3,030. So we got some amount in doctor visits. Now, it doesn't stop there. What about going to the dentist, the root canal, getting the dental services performed, right? So dental visits, right? Dental expenses, let's say about $1,700. If you're using a care credit, some of you folks have care credit cards. I think that's at the care credit where you finance the dental procedures. Well, it's on a credit card, so you can actually go ahead and use it because you shifted the expense from being from the actual dental office onto the actual credit card, the line of credit that you're using. All right, now let's talk about eyewear. Let's get those eyewears, right? How about, your eyes, your prescribed sunglasses? It's funny, my wife, she used to buy, I think 5 years ago, she had this look where she bought all these fake glasses, and, where she fixed her hair and makeup. So she had these different sets of glasses that she would wear. Not those glasses. I'm talking about prescribed glasses, right? So your eyewear, and let's go ahead and put that down as $750 in eyewear, right? And then now we've got our weight loss program, right? So our prescribed weight loss program at about $1,200. So we got our prescribed weight loss program about $1,200. So all together, look at this. So between the medication, the doctor's visits, the dental visits, the eyewear, the weight program, then we took in our miles. I don't care. It still gave us 260 miles. Altogether, we've got $8,870 in the actual medical expense deduction. That's a pretty good amount. So if we come back over here, for 1 second, let's come back over here to our Schedule A. We can see, okay, that $8,870, well, we've crossed the threshold of $3,750. So we've crossed that threshold. Now, since we've crossed that threshold, we're sitting at about $5,120, okay? So really being able to just sit down with the client and really go through and get an understanding. This is kind of what I had on my slide here earlier. I don't want to feel like you're getting in your client's business, but really understand their diagnosis. Do they have high blood pressure? Do they have diabetes? What's their medical situation like? Have they had any medical procedures that are taking place? Or it could be a tax planning tip. Maybe they're planning a medical procedure. Maybe they say, you know what, I'm thinking about getting a, XYZ, a service done or something like that. So, and I had it up on my screen here. What are some medical procedures that were up on here? And even too, let's bring this back up over here on Answer Connect. Even I think I had, if they're in a program to stop smoking, that's also a tax deduction, right? A vasectomy, right? Definitely psychiatric care. There's a lot of folks, I hate to say it, with the pandemic and all that's going on, a lot of folks are needing to speak to a psychologist or get some psychiatric care. That's a tax deduction. Even the chiropractic. How about those birth control pills, right? If you're quarantining with your spouse or quarantining in general, right? Those birth control pills, those are a tax deduction. So there's a long list of items. You want to make sure, and if you want to get this list, definitely you can get this list by going to our Answer Connect website. There's a subscription that you'll need. You could reach out to one of our sales consultants to get that subscription, but you can get this long list of items. You want to be able to go through. Look at this, even bandage and medical supplies are a tax deduction. Acupuncture, right? Now, let's talk about this for 1 second. Let's say hypothetically that you've got a client. Let's bring this back up on the screen here. Let's say that you've got a client that has been, permanently, laid off or something like that. They lost their job or something like that, due to COVID-19. If they lost their job and they go and buy health insurance, let's say they go and buy some health insurance, that's a tax deduction. Because remember, health insurance after tax, if you're paying it after tax dollars, health insurance is a tax deduction, right? So if they're buying health insurance, out of the pocket, you can take that tax deduction for that. So that's something here that you want to put. I'm going to come back to our Schedule A detail worksheet. That's something that you definitely want to come in and add in over here as well on your worksheet. All right, so we've got our medical expenses. We've addressed our medical expenses. We addressed our doctor's visits. We talked about birth control, right? Nothing that you thought has anything to do with taxes, but health and taxes do have a correlation. They do work together, right? All right, so let's come back to our Schedule A. So we talked about that. Now, let me just make sure I see something here. I think I've got one client in here. Yeah, okay, so my client is Miss Schedule A. Let me put in Mr. Schedule A, because I want to do it my example. I want my example to be a married filing joint. So I'm going to make up an actual social security number. Okay, perfect. So I've got a married filing jointly couple. I'm going to put their filing status as married filing jointly. So they're filing together. Okay, perfect. All right, perfect. So we got that information on there. Perfect. All right, so we've got that going through. So let's come back on over here to that Schedule A. Now we went through the medical expenses. Let's talk about property taxes, right? Let's talk about just taxes in general. Okay, taxes in general. So let's say you live in a state that doesn't have state income tax, right? Maybe you live in Florida, or maybe you live in hey, let's say maybe you live in Florida. Definitely, and you consider to itemize it. You definitely got the general sales tax deduction. We can calculate a flat amount, but definitely if your client has kept up with all their sales receipts, all their receipts, and they figured out how much sales tax they paid, go ahead and add that on there. Now I'm going to come back over here. I got a little W-2 in this return. So on my W-2, I'm going to put that they've had about, say $3,000 in withholding. and I'm going to put that they've had some state withholding. So I'm going to put the state of Georgia in here, and I'm going to put that they had $2,000 in some state withholding. So they're getting a little bit of money back. So they've got that scenario set up. So they're getting a little bit of money back, right, on the federal and the state side. Now that $2,000, as you know, that's going to carry over to the Schedule A. So that's the amount of state income tax that they paid, right? So that's coming over, what was withheld out of their paycheck. Now let's talk about the property taxes, right? Let's say this taxpayer owns a home. So let's go in here and talk about their actual property taxes if they own a home. So let's say, for instance, with this client on this particular home they own, let's say they've got some real estate taxes. I'm going to go ahead and put in here that they've got $3,000 in real estate taxes. They've got that $3,000 in real estate tax. My property taxes just came in the mail. Now, for those of you that attended our Schedule C webinar last week, definitely, or if you want to learn more about that on our Schedule C webinar that we actually had, or if it wasn't last week, it was a couple weeks ago, on our Schedule C webinar, we talked about if your client owns a business, right? If they're self-employed, they got a Schedule C, and what to do with the excess property tax. You got to remember now, property tax is capped, right? So let's say for instance, Luis has this beautiful home in Woodstock, Georgia, but Luis also has a vacation home in Panama City, Florida, or he has a vacation home, right? So Luis pays, $12,000 in property taxes for his Panama City home in Florida, right? But remember, with the Tax Cuts and Jobs Act, it's capped at that $10,000. So definitely, you probably want to, definitely reach out to us to learn more about. There's some deductions that we do have. Uh, there's some ways that you can use that. Okay, if the excess property taxes, if that client owns a business, you can still use that excess property taxes as a business use of home. So if they own a business and they work from home, or they use your home for that business, you've got some additional remaining amount that you could put in there. All right. So we've got some income taxes coming in here. We've got some for our main residents in here. Now, it just doesn't stop here. So you've got your real estate tax on your second property, right? Now, I live in the state of Georgia. So in the state of Georgia, it's law that when you purchase a vehicle, right, you have to pay the ad valorem tax, the sales tax up front. So typically you want to ask your client, did you purchase a vehicle? Did you make any major purchases for the year? Purchase a vehicle? Did you buy a boat? Did you purchase a camper, an RV or something like that? Those type of questions you want to ask. Or you definitely want to find out about their ad valorem tax, or we call them ad valorem tax. It's a tax. We call it a birthday tax. You pay this tax every year on your birthday. So you want to find out what that particular amount is. I'm going to go ahead and put $1,500 over there. So we've got that $1,500 over there. So, and you've got some other taxes that the client may be impacted with now. When it comes to property owned, right? This is the taxes they're paying on all the property owned, real estate taxes. So if they've got a vacation home, let's say the client owns some personal property, some land, things of that nature. So all the real estate taxes that they own, you're going to put over here. If they're being taxed, a tax on their property taxes, such as their boat, such as their motorcycle. My father-in-law, he rides a lot of motorcycles. All those type of things, you want to ask those questions. Do you have a motorcycle? Do you have a boat? You want to ask these questions. It may sound silly, but still ask, because I remember what you're trying to do, you're trying to retain that client, right? I should have put that as a polling question. What percentage of your clients do you retain each year? Because on average, clients, they're here 1 year, then they're gone the next year. But going through what the client perceives, and I learned it, I never forget when I sat down, that client sat in my chair, I think it was like 2011, 2012, she sat in my chair, and she said, well, you didn't ask me all the questions that the person last year asked me. I know you don't have a boat. I know you don't have a vacation home in Panama City, Florida. But she just wanted to hear the questions. She felt like I was doing a thorough job. She would have felt like I was doing a thorough job if I had asked her all those questions. Just ask the questions. All right. So we've got some property tax in here. We're capped at $10,000. Like I said, reach out to your sales consultant, or reach out to Luis to find out more about our webinar that we had around our Schedule C deductions, and we talked about what you can do with that excess real estate tax if the client owns a business and they work from home. All right, so now let's talk about the mortgage interest deduction. Now this is a practice pointer, right? I should have a red light flashing. Practice pointer, practice pointer, practice pointer. This is really big. So let's say they got some mortgage interest and they pay $5,000 in mortgage interest. Okay, that's pretty standard. We know that, right? You take a mortgage interest deduction. Now, sometimes there's some myths in here. There's actually a client, a person I used to know, and they thought that, you can take the homeowner's insurance as a deduction as well. They would come in here, I don't know where they got it. I think they would put it in some random area on their due taxes, but they would actually write off the homeowner's insurance over here. So I just want to make sure I make that clear that, the homeowner's insurance is not a deduction on this Schedule A itemized deductions. The mortgage interest, the mortgage insurance premium. So let's say you've got a FHA loan or something like that, and you've got a mortgage insurance premium that you're paying on there. That could be taken into consideration. You got to enter that in, the points paid. It's on the 1098 form. Now, let's talk about, we've got the mortgage interest. What about home equity line of credit? All right. Home equity line of credit. Now, there's been some changes to that home equity line of credit, right? With the Tax Cuts and Jobs Act. It used to be where, okay, the client gets a 1098, they got their principal residence that you're going to take a tax deduction for, but then they got a HELOC, right? That's right. They are locked in. Home equity line of credit, you are locked in, right? A HELOC. They're sitting on a HELOC right now. So because they're sitting on that HELOC, they're locked in on this mortgage. They're probably gonna be paying the second mortgage on their home. They're probably paying for 10 years or something like that. And on that home equity line of credit, it used to be where you just take a deduction for the home equity line of credit, but that has changed now. With the Tax Cuts and Jobs Act, for the home equity line of credit, it has to be that loan they borrow against their home, it has to be used for improvements to their home. Okay, so before, folks used to take out a home equity line of credit, pay off their cars, pay off their credit card, and just get it all, they got those payments they're making. So if you've got clients that have a home equity line of credit, I want you to call them. Call them today. Encourage them to refinance. So if the client, let's say the client's had the home equity line of credit for a couple of years, and they use the home equity line of credit to, I don't know, take some vacations, pay off some debt, start a business, right? Maybe they drew down their home equity line of credit. They say, maybe they got laid off, and they say, what, I'm going to draw down $15,000 on my HELOC and start a business during the pandemic, since I'm working from home, since I'm laid off. That interest on that HELOC is not deductible. So you want to encourage your clients to refinance. So after they've drawn down the money on the HELOC, encourage them to refinance, because then you can take the tax deduction for the actual, for the entire property over here. You could take that mortgage introduction. So that's something that you want to encourage them to do. So I'm going to come in here and let's see, I've got that $5,000 in there, $6,300. I've got that rolling through the return, but I hope everyone got that. Now, another thing that you want to ask your clients, if you see your client has a good amount, and there's some more rules to mortgages, and we're not going to touch on every single rule. Like if the client has a second home and things, there's some more rules to it. You definitely want to look at our CCH Answer Connect, our tax research, tax help tool, because it's going to specify what more the rules are regarding mortgages, because it's changed due to the home equity line of credit. But that's something that you want to take into consideration. Now, how many of you got clients that are day traders? Anyone got clients that are day traders or just trading stocks all day long? All right. So I got a handful of my friends that are day traders. Luis, I can't see the chat. So let me pull this back up over here. All right. So if you've got clients that are day traders, what you can do with your day traders is that if they're borrowing money to do their trading, right? If they're borrowing money to do their trading, you can definitely reach out to the client and find out if they're borrowing money. That's a tax. We can see it. 4952, so you can take an investment interest deduction. So that's something that could be taken as well in here. So you could really want to go through the client, and this is going to help them too. This is going to help the client. You're going through what the interest is that they're paying for their home, if they're borrowing money for investments, if they've got a home equity line of credit, you're going through that with that client, right? So right now I've got a $6,300 deduction over here for the mortgage interest. I've got a deduction over here for, I'm capped out at $10,000 for my for my taxes paid, and I've got a $5,000 deduction over here. So let's kind of recap where we're at right now. So far we've got $21,000 as a deduction for our actual itemized deduction. That's where we're capped at right now, $21,000, right? So what's our married filing jointly standard deduction? Let's come back and look at our 1040. We're capped at what is it? $24,400. That's our married filing jointly deduction, right? So pretty much that $24,400 is what's on the return. Client's getting a $313 federal refund and a $128 state refund. That looks pretty good. We're going to touch on charitable contributions in just a minute, but I want to make sure that I address this right over here. Let's say hypothetically, let's say the client didn't give anything to charity, right? Don't you love those clients that don't give anything to charity? I'm just kidding. Let's say the client didn't give anything to charity for that year. So this is pretty much all the itemized deductions that you have. Normally, and I'll say what I used to do, okay, I'm done with your return. I'm finished. We're done. Okay. But in this case scenario, it's always beneficial to consider, should we force it? Because I live in the state of Georgia. So in the state of Georgia, I'm going to take you over to the Georgia return here for 1 second. In the state of Georgia, when you take the standard deduction on the federal side, you get the standard Georgia deduction, okay? So standard Georgia deduction, you can see it right over here for a married couple, and I've got, yeah, just a married couple is right over here, $7,400. So I've got two, so sorry, I've got this $7,400 right over here. That's the standard deduction that's coming in right over here. That's what's coming in. So it's taking that $7,400 off that return. That's that standard amount. Now, what we want to do is we want to determine, well, when you itemize, because all my itemized deductions, my itemized deductions equal $21,000. So this is where we go the extra mile. This is where we create the value. Now, some of you folks are very creative in pricing your clients. So I want you to figure out how to price for this extra work here. So what TaxWise is going to allow you to do is when you scoot down to the bottom over here of the 1040, see this little checkbox. It says, if you elect to itemize deductions, even though the standard deduction is larger, check here if you were check here. So if I'm electing to itemize, even though the standard deduction are, I can check this box. So let's kind of add this up here first. So before we check this box, let's see what kind of refund is this client getting. Let's take a look at this here. So the client, they're getting right now, oops, let me come back down to the bottom. Client right now, they're getting back $313, 313, plus they're getting back 120, 128. So that client's getting back $441. Okay, all right. Now let's check the box and let's see what happens. Oh, look at that. Now the client owes $41 to the IRS, but look how much they're getting back from the state of Georgia. All right, take a look at that over there. So let's pull back up my handy dandy calculator. Let's pull this up right over here. So they're getting back $1,019 minus $41. So they're getting back $978. But if we take the standard deduction, they're only getting back $441. So by forcing our itemized deductions to the state return, what is the difference between 978 minus 441? That's an extra $537. Now, where I'm from, $537 is a lot of money to me. You could probably buy a laptop with that. You can probably have a nice weekend with that money, a vacation or something like that for a weekend getaway. So by going ahead and forcing the itemized deduction, right, you're able to add an extra 500 and some change. Now the client's going to owe $41 to the IRS. Fine, let them pay the $41. Who cares? They're getting back $1,000 from the state, a little over $1,000 from the state minus the $41. So they get back by $978. So this is something that you want to make sure that you determine, should you do this in this case scenario. All right, Luis, so let's launch the next polling question.
That's right. And as I launched the question, Anthony, there is a question in the Q&A. I was able to give you access to it. Sorry about that. So as I read it out, maybe you can take a look and see if we can answer it. The next polling question we have for you today is, in what percentage of the tax returns you prepare do you use the medical expense deduction? This is one of those questions where it will be very interesting for all of us to see how we compare against everybody that's in this webinar. The options are 1 to 10%, 11 to 20%, 21 to 30%, or higher. So definitely, if it's higher than 30%, still choose a 21 to 30. So what percentage of your tax returns do you use the medical expense deduction on? So we have pretty good mix here, Anthony. We have 50% so far, 1 to 10%, 36%. I'm sorry, 33% are saying 11 to 20%, and then 13% are saying 21 to 30. So very, very interesting. And I'll actually show the results for everybody just because there are a lot of percentages out there. I'm going to share that on screen so that everybody can see for a little bit and maybe compare yourself against other businesses, tax preparation that are logged in today. So that's the answer to in what percentage of the tax returns that you prepared, you use a medical expense deduction. So very interesting. Anthony, is that where you fall under too? The
Yes.
50% for your
Yeah,
returns?
yeah, actually 1 to 10% was what I was thinking about. That 1 to 10% deduction was what I was thinking about. So we got a good head of folks. I'm surprised we got 12% of the people in here. I'm sorry, no, we've got a good amount of people that say, 12 to 21 to 30% of their returns, they actually use the actual medical expense. That's really great. So hopefully in this webinar that the 53% that said 1 to 10%, hopefully you can encourage your clients to actually take this deduction. And also I encourage you, still go through questions, even if you know the client doesn't have that many medical expenses, still ask those questions because the clients see value in that. I'll never forget that conversation that lady had with me that day. All right, so it looks like Lorraine has a good question come up. Lorraine, I never had this question before, so it's a kind of a challenge. Let's kind of see the best way we can answer this. Lorraine is asking, if a client is on insurance from healthcare.gov, so they're using the Affordable Care Act, right? Affordable Care Insurance, or also known as Obamacare, using Affordable Care Act, and they paid during the year, they pay some taxes they pay some for the health insurance of the year, the exchange, and then when you do their tax, they have to pay that back. Can they use that deduction for that tax year? So the amount of insurance, the amount that they've paid for their premiums for insurance, that's something they can definitely take as a deduction, as an itemized deduction. So if they paid, I would say $300 a month, $300 a month they paid for health insurance, definitely $3,600 a year, they can definitely take a deduction for that $3,600 a year for the actual health insurance. Okay, so that's a good question. Now, the amount that they have to pay back on the Affordable Care Act, that's that's not a deduction on paying back, but I'm not 100% sure, Lorraine. So that's something that you may want to consider our CCH Answer Connect product on. So if let's say you do their taxes and they've got to pay back $200-300 in Affordable Care Act penalty, and that's a shared responsibility payment. So it's not a tax, but it's a shared responsibility payment. I am not 100% sure if the shared responsibility payment can be a tax deduction. I don't think so, but I want to encourage you to look at I'm going to pull this up here on our screen here for a second. I'm going to encourage you to look at our CCH Answer Connect product, and it looks like it's not listed here as a deduction that can be taken. Looks like it's not listed here, but you're more than welcome. And I'll just show you a little bit on how the product actually looks. So when you do purchase our CCH Answer Connect product, it's going to come up right over here. It's going to look like this. This is the dashboard where you start doing research and looking at things at. And then once you look at, I'm going to come in here and type shared responsibility payment, right? So that's kind of where you want to address that and type that in right over there. Once you kind of go through this, you can kind of look through it, and it's going to kind of give some examples of the share responsibility payment and so forth like that. So I want to encourage you to use our Answer Connect product. We really break it down in an easy to read, understandable format for you. All right, so we've addressed the actual, let's see, so we've addressed, let's kind of bring this back over here. No, actually close that, was a duplicate. All right, so we've addressed some of the actual expenses related to some forcing itemized deductions. We talked about, let's come back to our Schedule A. We talked about in good detail about some medical expenses, property taxes. We talked about some mortgage interest, but what about charity, right? Let's say you've got some clients that are very philanthropic. They love to give, right? They're big givers, right? It was pretty funny, when we had the shutdown back in the spring, I think Goodwill and Salvation Army were saying, okay, no more stuff, no more stuff, because while everybody was quarantining at home, everybody was just cleaning their house, getting rid of stuff, getting rid of old stuff. So let's talk about, when you've got some non-cash items to give, and also when you got some cash items to give. Let's kind of go through that and walk through that in the procedure, in the presentation. So of course, gifts for charity. Let's say, of course, we got charitable contributions. Let's say the client gave, oops, that's right, I forgot. It's a link field. Let's click over there, and TaxWise is linking me to a worksheet where I can be more specific with my deductions. All right, so we're coming back over here, and all right, so charitable contributions. So we could put in here, let's just say charity. Let's say the client gave $3,000 to charity, right? It's a pretty good contribution, $3,000 they gave. Now, this is the part, have you ever heard the saying where we leave money on the table? This is the part where I feel like as preparers, or sometimes the clients, I shouldn't even say preparers, the clients, they leave money on the table. This is the part where I feel like they do that, because right over here where it says charitable miles, it's 14 cents a mile. You're probably saying, well, 14 cents a mile, that's not a lot. That's not a big, it is, it adds up. So perfect example, if let's say hypothetically your client is, maybe they're a coach, right, for a nonprofit organization. Maybe there's a softball league or a football league or something like that, right? Your clients are coaching, right? And it's a nonprofit organization, and you're driving to practice. My son, I used to coach my son's baseball team. So driving him to practice, I used to leave the office from Kennesaw and drive, over 30 miles to get him to baseball practice, basketball practice when he did basketball, and then when he did, yeah, basketball practice. Yeah, well, yeah, when I was a baseball coach. So taking that as a deduction, because I was volunteering, I wasn't being paid to be the coach. It was a nonprofit organization, right? The county, it was a nonprofit organization, 501c3 organization, or 501c7, one of those 501c organizations. I don't remember the exact which one it was, but I was coaching a team, a nonprofit organization, and those miles. So let's say, so you want to keep track of that. Even if the client doesn't have much for this year, the next year they're gonna remember you. They're gonna remember you and say, you know what? Uh, you're a very good preparer, because you've got all these deductions that you think about. So let's say, for instance, in my example, I've got my example kind of, let's sit over here. So let's say in all the charitable contributions, 1,900 miles, right? And then my brother-in-law, normally my brother-in-law, he's big into this. So my brother-in-law would be the coach, and his wife would be the team mom, right? So the team mom has her responsibilities to drive around and pick up stuff and all this and get awards. Maybe you're going to get the plaques and the awards at the end of the season. So let's say the team mom, let's say she drove another, 1,430 miles. So altogether, that's $466. That's a deduction, especially if you find yourself in this case scenario where you're having to force the itemized deduction onto the state return, right? That's $466. That's money. That adds up. And that's just for their softball practice. What if that person, volunteered at their place of worship, right? Maybe they're, and also too, many of you folks were probably doing some volunteer work, at the food banks, right? Many of you folks were working at the food banks, during the pandemic, helping people, helping homeless people, helping hungry people, giving some of your time to charitable contributions. That's important too. So adding up all those miles between both spouses and figuring out, hey, we've got a lot of miles that we've driven on a volunteer basis. That's a big deduction. Okay, and then you've got the charity contribution of $3,000. Now let's get into the hot topic, right? Let's get into when the client cleans their house out. They finally say, my wife used to get on my back. Hey, when are you going to clean the garage? When are you going to clean the garage? So after a year of her begging me to clean the garage, I finally cleaned the garage, right? So let's talk about when I packed up my car and took multiple trips to the Goodwill. What did I do when I took those multiple trips to the Goodwill? Well, if the deduction is under $500, so if it's under $500, you can take that deduction on the return, right? If it's under $500, so you can take the deduction on the actual Schedule A. So as you can see right over here, but if it's more than $500, you need to use a form called 8283. Okay, so if it's more than $500, and many of you folks probably know that, but I'm going to talk to you about what's the best way to do this. I'm actually just going to plug it in here, add in the 8283. Just plug that in over here. And there's some limitations around that. So now, anywhere between $501 and $4,099. I look like the president when I put my hands like this. I look like the president. Let me stop. Anyway, anywhere between $501 and $4,999. That's, that's the amount that you can put on this form. If it exceeds $5,000, let's say your client was very philanthropic. Let's say your client gave a car, donated a car or something like that, then they have to get an appraisal. And there's appraisers, you can reach out to it. I encourage you, definitely do some research. They have to get an appraisal, and you have to attach a copy of that appraisal to the return that you're filing. You attach it to the e-filing. But now let's say in this case scenario, most clients, they probably don't get an appraisal. Maybe say it's household goods. I think yesterday I went to Goodwill. I dropped some things off at Goodwill. I was loading up my car yesterday. So let's put the date of donation, let's just say, okay, we gave those items in 10, 19, but this is the 2019 software. So I'm going to just put 2019. The date it was acquired. Sometimes it's hard to figure out the date it was acquired, right? It's various. Maybe you bought those things over a period of years, right? But it's good to use a generic date, something that you can just tie back to, something that just makes sense. I'm going to say that we acquired those things in, 09, 15, 2020. Now, some softwares, some solutions, definitely I know one of our solutions definitely allows us to put various. That's an option that you can definitely use various. That's available as well. All right, let me put my dash. Okay, data acquired. What's going on with my data acquired here? I think I'm putting the wrong date. All right, I'll put my data acquired in here. I'll put that in. Now, if you do need help or something about TaxWise that it does have, you have this little help feature. So I can click the question mark. And I click the question mark. Look at this. So okay, so the IRS doesn't allow you to put various in that way. That's why. So enter the date you acquired the item donated. If your donation was for an item valued at $500 or less, you don't need to complete this entry. Use the month and year. Okay, that's why I was putting the wrong format in there. Sorry about that. See, all right. So I'm learning something new. This is not just for you. I need this webinar today too as well. Okay, so I need to just put the month and the year. Okay, so the IRS doesn't allow you to put various like that with the slashes. So that's something that you can't do. Okay, so I learned something. So I was wrong from that comment I said earlier. I'm gonna go ahead and put 09, 2010. How was it acquired? Purchased, right? We purchased it. Okay, so the donor's cost or basis. How much do we pay for those items? So let's say all those household items put together, $1,200. Now the question comes up, do we need to keep receipts? I encourage your clients to keep receipts. Take a picture of the receipts, have your client, we have a client portal, a portal called CCH iFirm portal. You can create a folder in your client's portal for non-cash contributions, or call it Goodwill, Salvation Army, whatever you want to call it. But you can create a portal, you can create a folder in the portal for your clients to take pictures of the receipts and store those items there. I'm telling you, your client is going to appreciate you when they see that you're using that client portal, not just to store tax returns, but you're helping them through the year to keep up with their deductions. Your client's going to appreciate you. Now, the fair market value. Now, in most cases, you want to use what the actual value is for that's salvage value. What do you call it? The after use value, the use value, right? So when you go to Goodwill, they typically give you a little receipt, and it gives you a good way to kind of track that information, so you can kind of put it together. So I'm going to put the value in at about, let's say $3,000. Okay, so that's the value that I put in. Okay, I'm going to put this in as joint. Okay, so we've got that information. Now this is going to feed back over here to the Schedule A detail. Right, so we've got the charitable contribution 3466. Now let me ask you all a question. On this 8283, right? On this 8283, why do I have a cap over here? Why is it in the 50% section? Why is it not in this section? Okay, so the reason why it's here, so for non-cash contributions, okay, looks like we've got a question coming up. Okay. What do you have the client submit for proof of driven miles for these volunteering? Yeah, they can submit they can create a little spreadsheet. That's a good question that came up. So Chastity's asking a question is, what do your clients submit for proof of the driving miles? I would encourage you to have the client send you, like typically, for baseball or something like that, they have a schedule, some type of schedule or something like that. Here's the activities, we're going to be at this park, XYZ park, ABC park. Have the client print it out and say, hey, these are the places that I drove, these are the miles. Have them print it out and put that in the file. Now remember, they need to keep that in case they get audited. okay? And you want to keep a copy of that as well too, in case if you got to represent that client in an IRS audit. But have the client, especially if they're like a coach or something like that, or the team mom for baseball or football or something like that, have them print out the schedule, the roster of where the location of the each game is going to be held at, even the practices. Where's the practice going to be held at? Driving to the practices as well. But so good question. Now I want to address this over here. When it comes to cash items can be deducted at a 60%, up to 60% of the adjusted gross income. So if the client is very philanthropic and they gave a lot of money away to charity, up to 60%. And then you have a carryover. So any amount that exceeds 60% of their income, you have the carryover, 60% of their AGI. But the non-cash items, they're capped at 50%, okay? So the non-cash items are capped at 50% as a deduction on the return. So when you think about this with this client. The client gave some items to Goodwill. The client, gave some money to a nonprofit organization, and the client volunteered, at a softball league, or volunteered at their place of worship, whatever you want to call it. The client, they did some volunteer work. So all together, you're creating, I mean, this is a lot of money of a deduction that you're creating for the client. You've got over $4,000 of deductions. Now, if I come back over the Schedule A here for just a second, on that Schedule A, you were able to come up with about $4,666 of a deduction. You were able to come up with a pretty good amount of deductions just with those miles and with the non-cash items as well. Sometimes, the clients may lose those Goodwill receipts. Encourage those clients to keep those Goodwill receipts. All right, Luis, so let's launch the next polling question.
Absolutely. So the next polling question is going to be, and I think we have one more question in the chat, Anthony, while we do that. So the next polling question is, can I deduct homeowners insurance as an itemized deduction? So let me go ahead and launch it for everybody here.
Oh, I'm so sorry, Luis. We already, I'm sorry, we already addressed that one. I'm sorry.
Oh, great. Yeah, absolutely. So it's great. So possible answers are yes or no. For the most part, everybody so far is saying no. You cannot deduct homeowners insurance as an itemized deduction. I myself, Anthony, actually, I'm very interested in this answer
Okay,
because
sure.
I do pay a lot of money in homeowners insurance. So I want to make sure that I'm following the proper guidelines and, deducting it if it's a possibility. So where do you think everybody's going to fall here on this question?
I think a lot of people are going to say no. That's what I think.
And that's what's happening right now. So 75% are saying no, 25% of our attendees today are saying yes.
Wow.
So now increasing to 30. It's really fun to see. So I'm going to go ahead and close the poll right now and share the results out with everybody just real quick. The answers were 26% said yes, 74% said no. So Anthony, what's the real answer?
So the answer is for the Schedule A, as an itemized deduction, mortgage insurance is not a deduction. I mean, not mortgage, homeowners insurance. Mortgage insurance, excuse me. So mortgage insurance. So if you have mortgage insurance, let's say you have a FHA loan, you're paying a premium, MIP or something like that, mortgage insurance premium, you're paying that. That's a deduction. But homeowners insurance, like you're paying for your home, like how you get auto and home bundled together, that's not a deduction as an itemized deduction, okay? Now, if you own a business and you're self-employed or you work from home, you can use that as a self-employed deduction on your 8829. But that's I noticed some folks, that's something I just want to clear up. I noticed a couple of folks that were saying yes to that, so I definitely want to clear that up. But definitely, I encourage you, if that client has a business, still ask them to get that information to you, what they're paying for homeowners insurance. If you got a business, LLC or something like that, single member LLC, and using the home office deduction, or even if you've got a client that has a K1, and there's some ways that you can offset with the 8829. Definitely, I encourage you to look at that. All right, so we got just a few minutes left. We got about 5 minutes left. Everyone, if you want to post some questions in the chat box, definitely feel free to post some questions in the chat box. Another item that I want to make sure that I addressed here as well is when it comes to the actual casualty and theft losses. Now, this was a major change that took place with the Tax Cuts and Jobs Act, right? It used to be before where you used to be able to, okay, if you had some damage to your home, like let's say God forbid your basement flooded, and if your basement flooded, you used to be able to, use the casualty deduction if your basement flooded or something like that. No longer. So only if it's been declared a federally declared disaster, a federally declared disaster area. So my heart goes out to you folks that are out there on California, if your property's burning, or if you've got, in the south over there, if you affected by a hurricane or or something like that. As long as they've declared a federally declared disaster area, then you can take the casualty deduction as well. That's available for you, all right? But it's no longer available to you if you did not take the casualty deduction. Now, Luis, if you could launch that polling question about pricing, we got some folks in here that are new. They were actually on my TaxWise webinar earlier today, and they wanted to learn about some pricing because they're a new firm starting out. And I've got a question here that I want everybody to be a little transparent, be a little bit authentic about your firm. What do you normally charge for pricing? If you're doing a tax return that has a Schedule A in there, right? What do you typically charge? Do you charge $50 or do you charge $5? Just kidding. What do you typically charge a client that has a Schedule A itemized deductions? Please, there's some firms out here that are brand new to doing taxes and they definitely want to learn what's the average price that firms charge for doing a Schedule A itemized deduction return.
And Anthony, of course, it will vary by state. It'll vary even within the state, if you're close to a big metropolitan area, but still, it provides a good context as to what everybody else is charging. So we'll share the results, and it'll be interesting to see how you compare against everybody else. So definitely another one that I'm very interested in learning the results.
Absolutely. Now we've only got about almost 60% of folks answered, so we still got some folks here that have not answered. About 40% of you folks haven't answered. So please, definitely be transparent. Share if anyone's charging. If you charge more than $500 to do an itemized deduction, Schedule A return, yes, please give that feedback. And it does depend on, like Luis said, what city or location. Definitely I learned when I go travel around and do all these Get Wise seminars that what we charge for a particular return in San Bernardino, California versus what's charged in Atlanta, Georgia. Big difference there.
Show the number that TaxWise customers can call to learn more about TaxWise Online. Just contact your account manager. And if you're not using TaxWise, feel free to send me an email. If you have a question for me or Anthony, or visit our website at engagetax.wolterskluwer.com/TaxWise Online. So very excited to host once again another informative session, Anthony, on Schedule A deductions. If there aren't any more questions, we'll stay here in the Q&A for a few more minutes. We'll share out the link to the recording with everybody within the next 24 to 48 hours, and we'll be in touch. Anthony, once again, thank you very much. Enjoyed the session.
Thank you so much. I enjoyed the session as well too. I appreciate you. I hope everyone learned a lot from this session and you can increase what you charge to do Schedule A returns. All right.
Absolutely. All right. Bye-bye, everybody. Thank you, Anthony.